Good evening, ladies and gentlemen. This is Barry Norman on behalf of TradeFred, and welcome to our webinar on support and resistance trading. Tonight's class is sponsored by TradeFred, one of the world's leading Forex and CFD providers. There's many benefits when you trade with TradeFred. You get tight spreads, fast withdrawals, your funds are segregated, you have 5-star service, you have dedicated support, and vast array of trading tools, as well as free education. They offer news in their blog, their daily reviews, the economic calendar, and trading signals, all to all of their traders. Plus, they have their Forex Academy, where they'll answer all of your questions. They have ebooks, video tutorials, and webinars that you can enroll in to make sure that you can be one of the best traders out there. Now, remember, TradeFred is a regulated provider, so therefore, all of their client funds are held in segregated accounts. They have a dedicated client support network. They are regulated by the Cyprus Securities and Exchange Commission, CISIC, and they're also a member of the Investors Compensation Fund. So that means if anything happens, all of your funds will be covered by the ICF. Now, TradeFred is a regulated provider, so I'm therefore required to give you a risk warning. So let me read it and get it out of the way. Trading in financial markets may result in the loss of the deposited funds. Please ensure that you fully understand the risk and seek independent advice if necessary. TradeFred provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which is provided in this webinar is for educational purposes only and is not to be construed as a personal recommendation. Now, tonight we will be looking at some live charts. The assets I have picked have been picked at random. I am not here discussing whether you should make a trade or not. In fact, I picked mostly assets you can't trade on the platform so that you don't think that I'm giving you a trade recommendation. All traders must understand that there is a high element of randomness to the markets. Therefore, they will experience both winning and losing trades while following a trading strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. Now, when you trade with TradeFred, you get one of the best online trading platforms known to all traders. You have the Cerex platform that gives you everything in one concise, easy to view screen. There's no download necessary. You can trade from wherever you are, and it will work on any or most available browsers. And if you want, you can download and get all the features of an MT4 platform, but using their online trading, you can use it on any PC or Mac computer. You can trade anywhere, anytime using their mobile trader also, which is one of the most advanced, easiest to use mobile traders for any handheld device. And you get a world-class software. You get a range of languages. You get live news reports and in-depth analysis, whether you're using their desktop MT4 platform, their online trading platform, or their mobile device. As you also get signals pushed directly out to the platform. It'll tell you what assets, what direction, what indicators are supporting the decision, what the recommendations are. And it's pushed out live to the platform. And if you want notification, just click on notify me and it'll send you an SMS or an email if you're not online. So tonight's class is sponsored by TradeFred. Now also tonight's class is being recorded. And if you want to see a recorded version of tonight's class, just go to www.investing.com and go under the education tab and then look for webinars on demand, and you can see a copy of tonight's class. It'll be available there in about 24 hours. It takes a little time to upload it, edit it, and get it in place. So tomorrow, just go to investing.com and watch a recorded version if you have any questions in the class. Also, if you do have any questions, if you contact TradeFred, www.tradefred.com, they'll be glad to answer all of your one-on-one questions directly with a world's leading technical analyst or somebody from customer support. Now, support and resistance isn't very difficult, but it is a concept that every trader needs to understand. Defining the concept of support and resistance is fairly simple. When discussing it in the context of the stock market or the CFD market or the commodities market, it defines the level at which buyers and sellers step into a market or where the law of supply and demand come into play. Imbalances in supply and demand create support and resistance levels. For example, when an overwhelmingly high number of buyers step into the market, an indication of support is being put into the market. Conversely, a large number of sellers indicates there's an overhead resistance preventing an asset from moving higher. So imagine if you had said, I'll buy Apple when it hits 149. Okay, I don't know where Apple's trading, but you said, I'll buy Apple when it hits 149. Why? Because it was all written up in the papers about 149. Everybody's waiting for the earnings report. And so all of a sudden, Apple hits 149 and its sales up from 149. What happened? It's now created a support level at 149. It was a resistance level because the stock wasn't able to break above that, but some good news pushed it above it. So the resistance at 149 is where traders, or the price is where what happened is demand increased. Demand soared through, so the price soared through, and it created this level of support. If it was falling the opposite way, it would form a level of resistance because there was lots of sellers. So say whatever report came out wasn't as good as everybody expected, and Apple went up to 149 but wasn't able to hold there and fell back down. So what happens is 149 is now a strategically important price point, and it's what we call a resistance level because the stock wasn't able to break above that point. Now the price levels which create support and resistance only tell half of the story, because we mentioned a key phrase, overwhelmingly high. Volume is the second half of the equation and shows us the strength behind the selling and the buying as support and resistance levels. The stronger the buying or selling is at a support and resistance level, the more important of a signal is being given. Now, support and resistance comes in many ways. But before we talk in the ways that it comes, I know a lot of people don't really understand or can't really just understand this concept, and it's very, very important. So I'm going to tell you the story about the elevator. Now, say I painted you gold, and I wrote across your chest 1250, because you're gold, and gold is trading at 1250 today. But you're a gold bar, so you don't have any hands. You don't have any feet. Okay? And I push you in an elevator. Now, the door to the elevator closes and you start moving up. What is supporting you? The floor below your feet is supporting you. To move up, you have to break through that ceiling above your head. When you break through that ceiling above your head, what happens? It becomes the floor under your feet and supports you. And then the next floor becomes your next what? Resistance level, because you have to break through it to move up. Now, each time you move up, you create new support levels, and your objective is a new resistance level. Okay, now that works if the elevator is moving up. What happens when the elevator is moving down? It's exactly the reverse. Support becomes resistance, and resistance becomes support, because as price is falling, it's going to easily break through that floor below your feet. And so that what was supporting you has now become your resistance, because each time it's falling down is looking for something to stop it from going through. Now, this is generally the idea of support and resistance. It's a very basic, crude explanation, but it gives you an understanding of what these levels are. But you're saying, okay, so we have the floor above your feet and the ceiling above your head. How do I know what they are? Where does this all come from? Now, it comes from many different ways, but it all comes from what we call technical analysis. Now, let's take the easiest route possible. Because remember, you're gold, you're 1250, you have no hands and no feet. So you're stuck on this elevator. You can't control where it's going up or down, but you're very smart, so you can do some analysis. So when this elevator moved up and down with you in it, you were paying very exact attention to everything that was happening. So you saw when you were pushed in the elevator, you were on the ground floor of a low, several-story retail and office building. You notice on the ground level, there was a coffee shop, there was a donut shop, there was a 24-hour store, there was a women's boutique, there was maybe a hair cutter, and a couple odd and end shops. No big anchors. It wasn't a mall. But you notice there's lots of activity coming up and down because what is it? It's sitting right on a major bus stop and a major train stop, and the coffee shop is extremely busy. Now, all of this is just some analysis by observation. Now, when the door closes to that elevator, it goes up to the next level, and when the door opens, you see it's this dark wood, beautiful lobby and hallways, and you can see the names on the plaques outside, and you see doctors and lawyers and accountants and dentists. So you realize it's a professional building. Not, it's fairly nice big doctor's offices, but it's not a hospital. There's no emergency room. There's not going to be a huge amount of traffic except for the appointments. The elevator goes up to the next floor, and you see the same thing. So you have 2 floors of this huge building with nothing but professional offices. The elevator goes up to the 3rd floor, and it opens, and you see the sign, conference room 1, conference room 2, conference room 3, conference room 4, and you notice only conference room 2 has a conference scheduled at 1 o'clock in the afternoon. The other conference rooms have nothing. You also see that there's a law library up there and a medical library up there. Okay, because you just see the signs. When the door opens, you're just looking and seeing. The elevator rides up to the next floor and it opens. And it's a beautiful roof deck, a smoking deck. It's where the employees that work in the building can go smoke. It's where they can go have lunch, sit with their own lunch. And there's vending machines, and it's quite lovely. And the door closes and goes back down to the ground level. Closes again, it goes to the basement where it opens up, and you can see it's just the maintenance man, the cleaning, the house cleaning people, and the supplies down there, and the door shuts and goes back to the ground level. Okay. Well, this is a nice story, but this is almost the same story about assets. But then we can attach a couple more pieces of information. What are these pieces of information? Well, because we're knowledgeable and we understand the markets, we understand when the Asian market's open, when the European market's open, when the American market's open, we know what the economics comes to. We know times a day that there's economic events and stuff going on. We can use this to make some assertions about asset movement. In the case of the office building, we use our common sense. We know most of those professional offices are going to open around 9 o'clock in the morning. So we know a lot of traffic will be going to the 1st and 2nd floor as the employees come to work. Once those employees all come to work on the 1st and 2nd floor, we know there's going to be very little traffic to the 3rd floor because we know there's only a conference at 2 o'clock. But the doctors may be doing some research, the lawyers may be going up to the law library, so we'll get some traffic. But we also know that once all those employees come in, there'll be lots of trips up to that smoking roof deck. Now, we also know early in the morning at 6 or 7 or 8 in the morning, say hypothetically when the Asian markets are open, mostly what we're going to have is we're going to have the janitor and the cleaning staff going up and doing maintenance and cleaning the floors because really nobody's come to work yet. You may have some early birds come in, but not much. So we can again estimate or ascertain where we might expect price movement in that asset. Now, come 9 or 8:30, and again, you're staying in that elevator, you're stuck in there. The door opens and the elevator gets packed. Well, statistically, now you're starting to apply some knowledge. Because what do you have? You have volume increasing because you have a lot of people in that elevator. Now, you also know statistically, because it's now 8:30 in the morning, those people are going to either all get out on the 1st floor, all get out on the 2nd floor, or some will get out on the 1st and the 2nd. And you know most likely, statistically, that elevator will ride back down to the ground level, fill back up again, and go the same route. Well, if you could figure this out and add some statistics with it and make some knowledgeable assertions, you might be able to trade an asset between its support and resistance levels, because each one of these floors was a different support or resistance level that asset had to break. Now, indicators are a great addition when looking at support and resistance levels. So let's go back and we're going to bring it into the real world. Okay, this is because the indicators will act as another form of validation that a security is approaching a support or resistance level. Since support and resistance levels in a cyclical fashion mean that the price will bounce off the high and the lows of the range, oscillators are the best fit. Oscillators like support and resistance levels will bounce from one extreme to the next. So we have very good ones like RSI, stochastics, Bollinger Bands, MACD that will give you indications that we're expecting the market to bounce or break through these resistance levels. Then we have other indicators like Fibonacci levels, which actually give us support and resistance levels using other types of calculations. Now remember, support and resistance represent key junctures where the forces of supply and demand meet. In the financial markets, prices are driven by excessive supply and demand. Supply is synonymous with bears, and selling. Demand is synonymous with bulls, and buying. Now, these terms are interchangeable throughout. As demand increases, prices advance. As supply increases, prices decline. Once the supply and demand are equal, prices move sideways as the bulls and the bears struggle for control. So you're saying, okay, that's a lot of words. What do I do? How do I understand this? How do I put it on a chart? Because you want to make decisions. So let's go over to some live charts and let's figure out the easiest routes. And we're going to look at 3 different ways of getting support and resistance on our charts. So let me pop up the Euro US dollar. Now, this chart you're looking at is a chart that I've been using for class for the last 2 weeks. So all of these lines that you see on this chart were just established in class. This is not some unique, hardcore technical analysis. This is just a basic understanding of the markets. And you'd be surprised, but we talked about volume, correct? We talked about support and resistance, and we talked about adding another technical indicator. Well, that also forms a very good trading system for you. Now, the thing you have to remember about supply and demand, or support and resistance levels, is they hold good forever. The only ones that are important to you are the ones currently around the price. But once they're established, they will hold good till next week, 2 weeks, 3 weeks, when the price moves out of those support and resistance zones, it establishes new ones. But guess what happens? When the price moves back down into those zones again that you had before, they become good. So we can see that I established some support and resistance zones quite some while ago back here in the blue area, back when the euro dollar was trading in this range. They no longer have any validity for us because the prices moved way up here. But if we were seeing price drop back down, they would come back into account. They would be important again. As price moved up to this new level, I established these zones. And guess what? Price moved higher, then those moved out, fell back down. And look at how often price moved between these support and resistance, or even when it moved above, say it moved up to the floor, it came back down to that level, bounced off of it, moved back up, came back to this level again. See how important, and this level was created here. But see how, now today's price, this is a current chart. Look how important this support or resistance line is to today's current trading. This is the next level. And we can see how this was established back here, but look how important it was as the prices move forward. So right now, we would expect price to move between this support and resistance zone. Okay. Now you're saying, where did this guy get them from? Well, there are two basic ways you can get support and resistance. Okay. Like I said, there's many indicators that will give them. Okay. My favorite is called eyeballing, because eyeballing forces you to work with prices and the charts. Now, eyeballing means going back to prices when the asset was previously trading at this price zone and seeing what price was strategically important. How do we describe strategically important? Well, the more times that price hit that level and either broke through it or couldn't break through it or bounced off of it, the more important that price level is. So we would take a chart, and we got these lines by taking a chart and going back into when price was trading at these levels and looking for strategic swing highs and swing lows and drawing them forward on our charts to where the trading is today. The other way we get these is from what we call pivot point charts. Now, pivot point charts are mathematical calculations. They are constantly recalculating the support and resistance around the current price. And I'll show you how to get those in a second. But eyeballing isn't an exact science. And eyeballing, number one, gives you some advantages in the market, because you can then see and establish, based on price movement and reality, where you think what level prices are important. Now, you can have as many support and resistance zones you want. You can have major ones and minor ones. You can make zones between them. You can. This is where you get to put in your own personal trading strategies. This is where you get to test. But as you can see, if you want to trade this asset that we're looking at here, which is the euro US dollar, when we saw it come break above this resistance level, we would be looking for the next level above. And there's constant, there are rungs on a ladder. There's constantly levels above and below. Okay. But when it fell back down, we would expect it to find its support level at this level, this arms level. And then when it broke through, we would expect it to trade within this range. So we could say that every time it bounced up and hit that price level and bounced off that resistance, we could trade that asset to go down. If we combine that with volume, because as we put volume on our charts and we see that the traders are either jumping in and supporting that or not jumping in and supporting it, we can use that to support our decision. Then we have what we call RSI down here, which is an overbought and oversold indicator. We would like it to be in the 70 to 100 range above here or below the 30 range outside the purple area. It will tell us the market is overbought or oversold, but it isn't at this point. But we see a big drop in the RSI reading. So we might want to enter a trade at this point. We might want to say maybe this uptrend has moved into this downtrend, and this downtrend is now becoming valid. Okay. It's helping us establish or understand how an asset is trading. Now, this was eyeballing. The second route, and the more you combine different pieces of information, because also a trend line gives you support and resistance, because a trend line in an uptrend supports the prices above it, and you would expect price to bounce off in a downtrend. You would expect it to give you the resistance levels. So where the trend line crosses your support and resistance levels becomes also strategically important. And like I said, the third way is through, or the other way is through pivot points. And pivot points are a mathematical calculation, and you can get these all over the internet. They're not secret numbers. Okay. You can get a pivot point calculator, and you can get one on investing.com, Forex Factory, any place that provides you technical analysis information. And you just simply look for pivot points. Now, we're only concerned with the classic. And we want to make sure that our timing for our pivot points are on the same timing as is on our chart. And then we can see that the pivot point, which is not important to support and resistance, is 149, 124.19, and the current resistance, support and resistance level, that's the R1 and S1, are currently calculated at 123.96, which you see right here, and 124.33. And then we have resistance 2, resistance 3, support 2, and support 3. Those are the floors, 2 floors down, 3 floors down. Right now for class, we only have time to put one level on this. So we're going to take these numbers. Now you can also get them directly off what's called a pivot point calculator, which is the long list of them, or you can get them off of a pivot point calculator, which you're simply dropping in the numbers and it will do all the mathematical calculations for you. But it's just easier to go right on the asset under technical analysis, and just have them right there for you. So let's go back over to our chart. And what we're going to do is we're going to come over here and we're going to draw a straight line. And let's make this one purple, because we don't want to mix up the orange. And we're going to draw that 123.96. And look at that. It happens to be the same support line that we had the other day when price was traveling back here. And then we have 124.33. So we're going to put another line on here at 124.33. $124.33. Okay, so we have our purple lines above and below our prices. Now, remember I told you about zones. Well, because these are so close and we have our eyeball, and see how we did so well with our eyeball, and then we have our pivot points, what we would call these are zones, because they're just a few pips apart. So we would fill this in and make it a zone, and we make that a zone. But look at that. Both of these numbers happen to coincide with exactly where we had put these on from eyeballing. And we can again see how important, with all those candles touching those lines, how important those prices were. So because we have two different levels, two different techniques giving us this level, that tells us that these prices are very, very important, statistically more important. So this helps us make our decisions, because it reinforces the two ways we found it, with pivot points and with eyeballing. Now, let's go back to my PowerPoint. And discuss this a little bit farther. Okay, so let's talk about some tips for using support and resistance levels. One, we want to watch for breakouts. As we noted, prices can and do cross their support and resistance levels on the way to forming new trend lines. Use the current levels as guides, but realize they will change over time. Think of the changes as opportunities to make profit. So can you see some similarities between this chart that's up here now and the chart we had on the euro US dollar? So we could see how when price fell into this zone here and bounced off that resistance level, it offered us a buy, a sell point. When it came down to the support level and bounced off that support level, it gave us a buying opportunity because we were watching for price to break out. Now, two, when charting a price action of an asset, expect to at least see 2 price bounces before considering a given high or low to be a resistance or support level. Preferably, you want to see 3 bounces, since each one strengthens the signal. So what we want to look at is the support and resistance and see how many times in the short-term history has that price been strategically important. The more times prices touched that support or resistance zone and bounced off of it, the more important it is and the more it strengthens the signal. 3, asset prices tend to test support and resistance zones without breaking through them. You will become nervous when this happens. It's normal. Calm your nerves and learn to trust your charts. When a breakout occurs, it usually does so in the context of forming a new price trend. Your chart should give you a heads up about that in advance. Okay. Now, remember, don't get lazy with your charts. The more you trade a particular asset, the more you'll feel as you know how its price will move. Be warned that, especially with binary options, have a way of surprising even the most experienced traders. Intuition is important, but tracking price action, keeping accurate charts, and collecting reliable data are much more so. If any of the above concepts seem complex and confusing, don't worry. With time, you will find that they are actually simple to understand and apply. Most of the complexity is due to the lack of familiarity. Now, when a price of an asset is moving, okay, now remember, especially if you're trading Forex, prices have a tendency to push up and then to fall down, push up and to fall down. Even when they're trading in a downtrend, a proper trend will move in what we call pushes and thrusts. Price will push down, then bounce back up, and then push down, bounce back up. This is the normal expectation of a trade. There are peaks and valleys as price moves, because price doesn't move in one straight direction. Because what traders do in this downtrend, they're selling. At some point, the sellers say, okay, we're going to sit tight, but the buyers don't want to enter the market. Okay, and a few buyers come in, and then the price bounces up, and the sellers say, that's a good point to re-enter the market. The sellers jump in and push the price down again. But then the sellers are exhausted for a while. So the buyers take over and the price rises to where the sellers say, okay, it's time for me to go back in. It's a good price to buy it, it's to sell. And it creates more price movement. Okay, so these are critically important levels in the life of a price movement. And you have to get yourself aware that this is the way price should move. This is the way a trend should move, whether uptrend or downtrend. Push and ease, push and ease, push and ease. And if you understand trends, there are actually points that a trend will make higher highs and then lower highs, higher highs and lower highs, or lower lows and lower highs, depending whether it's an uptrend or downtrend. And when you understand that this is the proper way for a trend to react, those higher highs and higher lows are forming support and resistance levels. And in that life of that trend, it forms many of these. And then when the price is moving in the next direction and reverses in an uptrend and starts moving the uptrend, you can then figure out each one of these levels where buyers and sellers in the past have figured the price was too high or too low. So another group that makes up resistance are the ones that bought at or near resistance and are trapped when price fell at resistance. These traders are begging for price to come up one more time so they can get out at a break even. Now, all of these groups work together to send prices lower and make up supply in the supply and demand equation. More supply than demand, prices fall. More demand than supply, prices rise. So in this chart here of the pound, we see the support are highlighted in the blue while levels of resistance are highlighted in the red. But look at when we look at the life of this asset. Now, we see this is the pound, and this is an old chart, but we see the pound push, ease, push, ease, push, ease, push, ease, push, ease. And each one of these created these new support and resistance zones. So if we were able to pull these forward, these are what makes up the crucial support and resistance zones as the prices starts moving back down. Push and ease, push and ease, push and ease. And you'll find that these pushes and eases will fall on these support and resistance levels that were created in the past. So Forex traders are able to identify several places to trade within a trend. The levels of resistance can be used as profit targets areas and breakout opportunities as price closes above the resistance. So not only do they offer you trading opportunities, when you've entered a trade, it also helps you decide where you would want to put your stop loss or where you'd want to continue in the market. Because if you see price, if you decided you see this pound moving up on this chart and whatever other method you're using to enter the market, you want a very important level. If you decide you want to buy, you want to find that support level and place your buy order, because you don't want to place market orders, you want to place limit orders at slightly above that support level. So when the price moves up and falls back down, bounce off the support level, you want to generate your buy. Okay, you want the computer slightly above there. And where would you want to place your stop loss? At the previous support level. So you want to make sure that you can afford that fall down to that support level when you're figuring out your risk reward cycle. And where might you want to watch for the next step of the ladder? So you might want to put your take profit point at the next resistance level, because you're not going to sit there glued to your charts and your price movement all day. So you need to set up your order with your profit points, your target points, your stop loss points, your order entry points, so that you can take advantage of the market movement. So remember, eyeballing was my first step, because technical analysis is not an exact science. It is useful to create support and resistance zones. Each security has its own characteristics, and analysis should reflect the intricacies of the security. Sometimes exact support and resistance levels are best, and sometimes zones work better. Generally, the tighter the range, the more exact the level. If the trading range spans less than 2 months and the price range is relatively tight, then the more exact support and resistance levels are best suited. If a trading range spans many months and the price range is relatively large, then it's best to use support and resistance zones. Sometimes you have to go back pretty far to find support and resistance levels, because the price of that asset hasn't traded at its current price level in quite some time. So the older or the longer, the farther back you have to go, and the less times it's been important recently, the less important those levels are until that they are retested. So identification of key support and resistance levels is an essential ingredient to successful technical analysis. Even though it is sometimes difficult to establish exact support and resistance levels, being aware of their existence and location can greatly enhance analysis and forecasting abilities. If a security is approaching an important support level, it can serve as an alert to be extra vigilant in looking for signs of increased buying pressure or a potential reversal. If a security is approaching a resistance level, it can act as an alert to look for signs of increased selling pressure and potential reversals. If a support or resistance level is broken, it signals that the relationship between supply and demand has changed. So there are other ways, like locating swing highs and swing lows. So we went to the live chart and we looked at them, and we could see that the more times an asset is bounced off of that support or resistance level, especially moving forward. So we can see all of this on this Japanese yen here. We can see all of these times that it has tested this purple level. Now we see moving it forward, we can see this would have given us an excellent place to watch for a short. Now, we can also combine this with Fibonacci levels, which give us levels of support and resistance. But remember, the more times that price bounces off support or falls back to resistance, the stronger these support and resistance levels are. The more those historical patterns repeat themselves, the more traders know and the more confident they become forecasting the future behavior of an asset. Understanding the concept of support, resistance, trading ranges, breakouts, and breakdowns can be quite valuable to all traders. Support and resistance is one of the strongest and most dependable tools available to the trader. Remember that it's best to use any tool along with other indicators when deciding whether or not to take and when to take or exit a position. Support and resistance analysis is an important part of trends because it can be used to make trading decisions and identifying when a trend is reversing. For example, if a trader identifies an important level of resistance that has been tested several times but never broken, he or she may decide to take profit as the share price moves towards this point because it is unwilling or unlikely that it will move past this point. So remember, we have our pivot points, we have our eyeballing. We have many ways to get this. We have GAN fans out there. But any experienced trader will tell you many stories about how certain prices have become embedded into an asset's movement. So remember, verify support and resistance. Look for or notice that they change. Support will become resistance and resistance will become support. The more it retests, the more important it is. Volume reinforces your decision, and time matters. So support and resistance are just key mile markers in a security's progress. Whenever you're developing a trading strategy, consider these points on a graph. Doing so will help you set profit targets and prevent frustration when eventually reversals do occur. And on that note, thank you very much for joining us tonight. If you have any questions, just go to www.tradefred.com and send them to customer support or contact them, and they'll set you up with a technical analyst who can explain this to you on a one-to-one basis. But go to www.tradefred.com, and remember, they're a regulated broker. They provide you all sorts of education, and they'll always make sure that you understand what's happening and make sure all of your questions get answered. So thank you very much for joining us, and best wishes. And remember, you can see this recording version of this class tomorrow on investing.com under education, and then go to webinars on demand. So have a good night, and I hope you learned a little bit tonight. Good night now.